Well, hi gang, welcome back. This is an alternate version of exercise 5-2 from chapter 5 on page 258 of the textbook, recording and adjusting entries. Recording and analyzing inventories. Let's take a look at the problem here. In this particular problem, we're going to do an analysis of inventory errors for a Vibrant company. It said that they had $930 in sales in each of the 3 consecutive years, 2015, 16, and 17. It purchased merchandise costing $515,000 in those years. It also maintained an inventory of $230,000 from the beginning to the end of the 3-year period. Now, in accounting for inventory, it made an error at the end of year 2015. Well, that caused its year-end 2015 inventory to appear on the statements as $210,000 understated, rather than the correct amount of $230,000. So if we refer back to the earlier problems, we know that when we have cost of goods available for sale, we subtract out of that number our ending inventory, and what's left over is the cost of goods sold. So if we make a mistake, count things wrong, that's going to affect not only our ending inventory in the balance sheet, but it's also going to affect on the income statement how much we expense out as cost of goods sold. And if we expense out too much, if cost of goods sold is overstated, we're going to be shortchanging us on what our gross profit and net profit is. Net profit is going to be understated. If cost of goods sold, though, is understated, net profit is going to be overstated. So this problem is going to take a look at what happens when the ending inventory balance is understated. Here it appears as 210 rather than what it should have been as 230. So first, let's determine the correct amount of the company's gross profit in each of the years. So we have our basic income statement. It's in comparative form. And we have sales, and the sales comes right up here from our beginning date at $930,000. And that's going to be our sales for each and every year. So let's just total those up for all 3. 930 plus 930 plus 930. Cost of goods sold, we'll calculate. We're going to calculate that by taking the beginning inventory of $230. We'll add our cost of purchases, which it says it purchased merchandise of $515. So we started off with $230 and we bought $515. That gave us goods available for sale of $745. Okay, so we had goods available for sale of $745. What are we going to subtract out of that to come up with our cost of goods sold? Well, we're going to take the goods available for sale, subtract out ending inventory of $230. Remember, that's the correct amount that we're doing here first. And that means that our cost of goods sold is the difference. So $745 minus $230. And our cost of goods sold is $515. You can refer back to the T accounts when we did those long inventory problems on LIFO, FIFO, average cost, and specific IID, just to kind of refresh how that flows. But left side's cost of goods available for sale, bottom is inventory. Subtract that inventory that you end with from cost of goods available, and what's left over is cost of goods sold. Okay, so let's take the sales of $930 minus cost of goods sold of $515, and that gives us gross profit of $415. Now notice for this company, that's going to be the same for each and every year. Each year they have the identical sales, the identical purchases, so gross profit is going to be the identical for each year for the company. All 3 years together, sales total up to $2790, cost of goods sold to $1545, and gross profits $1245. So this is the correct way. Now notice that everything is smooth. Gross profits $415, $415, $415. We total all 3 years of gross profit together, and that gives us our 3-year total of $1245. That's an important number to pay attention to, that $1245. The $1245 is significant because all the years together are totaled up. Now notice that gross profit for 2015 was $415, and that's the same for all the subsequent years. Keep that in the back of your head as we move now to the second part of the problem. So on the second part of the problem, it says, prepare a comparative income statement to show the effect of this error on the company's cost of goods sold and gross profit for each year for year 2015 and 16. So remember what's happening here. They it should have been 230,000 of ending inventory, but they did something wrong. They counted it wrong as 210,000. So let's look at how that error affects the company's income statements in the current year and in the following years. So we have our sales of 930. That stays the same. We can run that across the top. And then we have beginning inventory of 230,000. Our cost of purchases, we still purchased 515,000. That gives us our goods available for sale, still of 745. But here's where the error started. Here they made a mistake. They undercounted inventory. They says, you know what, inventory is 210, but really it should have been 230. So as a result, our cost of goods sold is being what? Understated or overstated? Well, it's being overstated. Let's take a look at the chart that refreshes our memory from the Learn Smart modules. When ending inventory is understated, we're saying that we must have expensed out more than we should have, so cost of goods sold becomes overstated. Think about this. If you have $500 of inventory and you should have had $100 left, but instead you counted only $50 left. Well, your cost of goods sold should have been $400, but because you miscounted, your cost of goods sold is now going to be $450. So when ending inventory is understated, cost of goods sold gets overstated. Therefore, net income gets understated. Now, what happens in the next year, though, is that corrects itself. Then in the next year, the cost of goods sold gets understated, and what happens to the net income? It gets overstated. So it gets washed out. So just remember this little chart. It'll be really important as you solve different problems down the road. Ending inventory understated, cost of goods sold is overstated. Therefore, net income is understated. And that gets flushed out and fixed in the second year. So let's go ahead and look at the rest of our data then to see what happens in the second year. Now that $210,000 that we ended with in 2015, that becomes our starting inventory in 2016. We add to it the $515,000 in purchases, makes goods available for sale of $725, and now we correctly count how much is left of $230, which brings our cost of goods sold though down to $495,000. There was that $30,000 shortage. We are over 30 in this year, we're under 30 in this year, which brings our gross profit to $435. Now we go into 2017. What are we going to begin with? We're going to begin with what we ended with from 2016. 230 is what we start with for 2017, 230. Bought 515, goods available of 745. Subtract out our correct ending inventory. Remember, the mistake was just made in 2015, and we have what our correct net income should be of 515. I said 30,000 earlier. I meant 20,000 was the amount that was off. So now in 2017, that's correctly stated, isn't it? We should have had actually that 515 as our cost of goods sold for every year, and our gross profit of 415 for every year, just like we saw when we did it in part 1. What's the cumulative effect of this error? Well, over time, it still all balances out because we were $20,000 shy of gross profit in this year, $20,000 overstated in this year. We add them together and they cancel out, and we still have our exact same level of gross profit that we had during part 1 of the problem of $1245. So just know that when there's an error made in ending inventory, when that ending inventory is understated, you're reporting less than you should have. Well, that means you're expensing out more than you should have. So your cost of goods sold is going to be more than it should have been. Therefore, if that expense called cost of goods sold is overstated, what's going to happen to your net income? Net income is going to be understated.